Alright, so hello guys, my name is Yoshwan Jagadiswaran and my code number is 012024070499. Alright, so today I'm going to be speaking about basics of accounting. Alright, so what is accounting? Accounting is often called a language of business. It helps organizations record, summarize and interpret financial information to ensure consistency and reliability. Accounting is built on several foundation concepts. Some of them are the separate entity concept, and then the going concern concept, the money measurement concept, and the objectivity concept. Alright, so what is separate entity? The separate entity concept means that a business is treated as a distinct from its owner or owners. This means that the financial records of the business are kept separate from the personal financial of its owners. For example, if the owner buys a personal car, this transaction is not recorded in the company's books because it's for personal use. It's not a company's use. Okay. Only business related activities are included in the company's accounting, such as if you buy something like you buy furnitures for your business and all that. So that will be accounted as company's accounting. This concept is important because it ensures clarity and accuracy in financial reporting. Alright, so the second one is going concern. What is going concern? Okay, so the going concern concept assumes that a business will continue to operate for the foreseeable future unless there is evidence to suggest otherwise. In other words, we assume the business won't shut down or liquidate anytime soon. This assumption always allows businesses to record long-term assets, spread expenses like depreciation over several years, and avoid valuing assets at liquidation prices. If a business is no longer a going concern, the financial statements would have to reflect with the significant changes. Okay, so this is something like long-term basis kind of like accounts. Alright, the third one is money management. Okay, what is money management? Money measurement. Okay, what is money measurement? The money measurement concept states that only transactions that can be measured in monetary terms are recorded in the accounting system. This means that event or items like employee morale, company reputation, or leadership quality are not recorded, even if they affect the business. Okay. So accounting focuses only on quantifiable financial information. For example, a purchase of machinery is recorded because it has a measurable cost, while an increase in customer satisfaction is not. So something that is purchased regarding to the company, and maybe it might be long term or short term, that's how they measure the money. Right? So that is money measurement. Okay, moving on to the next one, objective. Okay, so objective, what is objective? Objectivity, The objectivity concept requires that financial information be based on verifiable evidence, not personal opinions or biases. This means that transactions must be supported by documentation like receipts, invoices, or contracts. Objectivity ensures that accounting records are reliable and can be trusted by external users such as investors, creditors, and regulators. It also promotes consistency and reduces the risk of manipulations or misrepresentation. Alright, so these are some of the concepts, which is 4 concepts from a part of the foundation of accounting. Understanding them helps in producing accurate, fair, and useful financial information that supports the decision making in any organization. Alright, so this is for my part. I will pass to my next teammate to represent their parts. Alright, so thank you so much, guys.
The actual context meant that transition are recorded when they happen, not when the cash is received or paid. For example, if a company provides service in December but only gets in the payment in January, the revenue should still be recorded in December. This will help show the real performance of the business during a period because it matches income with the expenses that happen in the same time frame. Without the accurate context, financial statement may look misleading, like showing profit or missing some expenses that already corrected. Materiality content. The materiality content say that only important or significant information shall be recorded in financial statements. In simple word, if something is too small to affect the discussion, it can be ignored. For example, a company doesn't need to record every small item like $2 pen separately because it's not important enough to change how users view the business performance. These compares help account focus on what really matters for decision making, keeping reports clear and practical. Consistency content. The consistency content means a company should use the same account method from one report another. This helps financial statement remain comparable over time. For example, if a company uses the straight line method to calculate depreciation, it should continue using that same method every year unless there's a valid reason to change. Consistency build trust and reliability because the stakeholders can easily compare the results between years and you understand the business trend.
Hi and Assalamualaikum. My name is Jasnita binti Iswandi, and today I will present about my part, which is comparability, prudence, historical costs. This principle help make financial information more useful and reliable. So my first point is comparability. Comparability means that financial information can be compared between different periods or different companies. For example, if a company uses the same accounting method every year, it's easier to see whether it's doing better or worse. In short, comparability helps user make meaningful comparison. So my next slide is my next point is prudence. Prudence means being careful and not overestimating income or assets. Accountants should record expenses and losses as soon as they are known, but only record income when it is done. This prevents the financial statement from looking too optimistic. My last point is historical costs. Historical cost means recording assets at their original purchases price. For example, if a company bought land for 100,000, it stays recorded at that price, even if the land value increased later. This principle ensure that financial records are based on actual verifiable costs. So, in conclusion, these principles make financial information more consistent, reliable, and useful for decision making. Thank you.